been sitting on almost no deals. And now we have more people than I can count talking about animal spirits. And the first place they look to are banks and private equity shops.
Yeah, so definitely bullish on banks to your point. Strong consumers, steeper yield curve, and also more activity on the deal front. And so we do see that because financial conditions are supportive, because CEO confidence is high, you've also had private and public market valuations really stabilize. And so these growth companies have had a couple of years to be able to grow into the exit valuation that GPs want. And then the third thing is if you look at the aftermarket performance of IPOs and you look at the acquirers in an M&A situation, they both perform well in 2024. And so that, coupled with deregulation, really bodes well for deals across sectors and across market caps. But to your question, we actually did increase our allocation to alternatives, and we took that out of non-U.S. equities. So we still want exposure to non-U.S. equities, some of the best companies in the world, but we actually incrementally increased our allocation to both buyout and growth.
When you say increasing your exposure to alternatives, can you give me more specifically sort of what it was in terms of the overall, breakdown to what it might be now?
Yeah, so it's very much customized to a client's risk tolerance, but I would say we're anywhere from 25 to 30 to 35%. Some clients of alts.
Wow.
Yeah, and within alts, private credit, growth, buyout, venture, real estate. So a lot of subsectors within there, but buyout is the largest component. And as I said, we increased our allocation to both growth and buyout, and the reason why is there's a tremendous amount of innovation that's happening in growth. And then in buyout, especially middle and upper middle market, these GPs can just add a tremendous amount of operational value to the companies, and they have multiple paths to exit. This is also a space where you've seen tremendous alpha versus public markets, and the distribution of outcomes from a performance perspective has been more narrow.
Great to catch up with you again. Thanks for coming by.
Thank you.
That's Goldman's Mina Flynn joining us back at Post 9. Up next, star strategist Chris Ferrone. He breaks down the charts. He's flagging signs of life in one of 2024's beaten down sectors. He'll tell you which one next.
NBC.
Welcome back. S&P 500 hovering near a new closing high, and some of the sectors that sat last year's rally out are showing signs of life, too. Our next guest sees some bullish technical signs in one of those sectors. Here to share, Strategas' head of technical and macro research is Chris Ferrone. Good to see you again.
Great to be here, Scott.
Overall, market looked pretty good to you. I mean, there were a couple of days where breadth was kind of squirrely.
Yeah.
How do we read all that
I think we're in decent hands here. I mean, this was an important week. We had about half the S&P make a one-month high. That's generally a pretty decent sign. And I think the key, at the start of any year is as quickly as possible getting in gear with the leadership, recognizing what is holding over from last year and also looking for signs of change. I think the good news is the financials and the industrials, which are the holdovers from last year, are still very much involved in this market. I think the change we're beginning to see is maybe some shot of life from healthcare here, finally starting to perk up after what's not just been a dismal 24, but really a pretty bad last several years.
I mean, to your point, for those who are looking at their returns of the last year, and you see gains in almost every space, 25, 30, 32%, 36%. Materials sticks out like a sore thumb at only up 7%, but healthcare was horrible.
Yeah, it was awful.
It hasn't done anything.
It hasn't done anything. If you may not know, healthcare's weight in the S&P is at its lowest weight in about 25 years. So you have this generational oversold condition in healthcare's weighting versus S&P. You also have a very apocalyptic sentiment backdrop. Those are interesting in their own regard to kind of set the table or set the stage for what could change. What we need to see as followers of the charts is hints of life or a spark of momentum, and I think we got that this week. You had the best new high reading in healthcare. About 60% of healthcare been a new high this week. First time in 2 years we've seen something of that magnitude. You're starting to see some breakouts. You're beginning to see some life in the relative performance, and it's all against the backdrop of what has been liquidation in flows. If you look at the ETF flows out of healthcare, they've just been totally liquidated. So I like this setup as a contrarian play through 25 here.
Within that space, you like medical devices. Why did you single those out?
Yeah, it's the first to turn. It's the place where you're seeing the biggest price improvement. Names that come to mind, Agilent, Abbott, ABT. You're starting to see some hints of life in pharma, too. Bristol Myers is one we own that has started to turn here as well. So it's starting to brew. I think importantly from a behavioral perspective, the fact that Lilly's broken down was actually necessary to get this going. I didn't think you could have healthcare in aggregate turn until the leader actually succumbed, and we certainly have seen Lilly succumb here.
Investors are clearly banking on American exceptionalism, right? We've heard that 3 million times already in the early part of this year, and that's what obviously Trump 2.0 hopes to deliver on. Within that, though, you suggest there's too much pessimism about outside the U.S.
Yeah, it's funny. One of the things that we always look for in our work is when the price action differs from the consensus view of the world. And the front page of the FT this morning was Christine Lagarde talking about how pessimistic she is on Europe. I want to be a buyer of pessimistic central bankers. That's good for monetary policy. And when you see...
Well, because you think they're going to just continuously cut rates into that?
Yeah.
Because their economies are not great.
Yeah, but when you look at the price action, Eurobank's new highs, Euro Industrial's new high, Euro luxury stocks turning up, European credit conditions very benign, European outflows very pronounced, and a pessimistic central bank, that's a very bullish combination that I have help from the monetary policy makers. At the same time, price is beginning to respond. So I think we really ought to consider Europe here undergoing some pretty important turn. Think about these luxury stocks. LVMH, Hermes, Richemont, they had terrible, terrible numbers, and they didn't make new lows on it. They've all bottomed over the last 3 or 4 months. And I think the reality of this business is things don't bottom on good news. If things bottom on good news, it'd be easy. Things bottom on bad news. You have to recognize when stocks become resilient to it, and you're seeing that all throughout Europe here.
I would only say, what role, though, does China play in a turnaround in those stocks? I mean, there's still a lot of pessimism about what's happening in China.
Yeah, and I mean, it's another place where the outflows are pretty pronounced. So the sentiment or the cushion is probably much larger in those places than it is here, where I think the margin for error in the U.S., while everything still looks okay, the margin for error is probably smaller because sentiment is certainly more robust than we're seeing in other parts of the world. But this turn in Europe, we're having a hard time convincing people of it. Yet when you look at the charts, particularly the European banks, it's hard to say there's a financial crisis or a recession that's getting worse in Europe when the European bank stocks are making new highs across the board.
All right, we'll leave it there. Good insight. Thank you for that. That's Chris Ferrone, Strategas. Getting some news out of Washington yet again today. Eamon Javers has that for us. What do we learn now, Eamon?
Scott, the president has been talking to reporters inside the Oval Office as he's been signing some executive orders over the past couple of minutes. We'll have that tape out here momentarily, but a couple of headlines to bring you as we talk about that. One is that the president talked about interest rates and the Federal Reserve. He has told the reporters that he would consider talking to Jay Powell about interest rates. He said to the reporters that he does expect the Fed to listen to him on interest rates. And this is, of course, the president who earlier today, speaking to that crowd in Davos, said that he will demand that interest rates come down. So that's one bucket of headlines around the Fed and his relationship with Jay Powell. Another one is going to be on an executive order here on cryptocurrency. We're waiting for a little bit more detail from the White House on exactly what this document that he signed is, but he's creating a working group on crypto, which will have David Sachs involved. David Sachs was in the Oval Office with the president moments ago, explaining the details of it to reporters who will explain it to us when they come out to the press briefing room. But it does look like there's a working group here and maybe some more details from the White House changing federal policy on crypto. So a couple of different buckets there to watch for, but particularly interesting in terms of his relationship with Jay Powell, Scott, and so much attention had been focused on whether or not he would try to remove Powell, whether that would even be legal. He has signaled that he wouldn't do that, but clearly today we're seeing an effort by the White House to rattle the cage a little bit over at the Fed. The president saying he expects the Fed to listen to him when he talks about interest rates.
Yeah, we'll follow that for certain. The crypto news interesting, but just to underscore, a working group, not a definitive national digital asset stockpile of yet, correct?
Yeah, we're going to wait for some details here, Scott, and I've got to go back in the building and get the actual document in writing to see exactly what's in there. But what we know right now is that Sachs was talking to reporters about this working group, but we'll get more detail here in terms of what's in the black and white, because a lot of this can be whispered down the lane from people who are in the room to us, to you, and we want to make sure we get it right.
Yeah, I got you. I'll let you go do reporting on that. Eamon, thanks so much for that update. That's Eamon Javers, as you see, on the north lawn of the White House. Up next, we track the biggest movers into the close. Back to Christina for that. What do you see?
Well, we're seeing a major gaming company seeing its stock crater due to disappointing sales, while a legacy airline struggles with mounting losses. Details next.
$15 from the bell. Back to Christina now for the stocks that she is watching. Hi there.
Electronic Arts, EA shares plummeting 17% right now, marking their steepest decline since the Great Recession 2008. The gaming company warning that its financial results will be weaker due to slower sales of its soccer game, that would be EA Sports FC 2025. That's soccer in the UK, and its role-playing game Dragon Age. Wedbush calling shares dead money for another quarter, but sees a rebound once the company provides a release schedule for all their new games in 2025-2026. American Airlines disappointed investors with a wider-than-expected loss, attributing the miss to higher fuel and labor costs, as well as an increased mix of regional jet flying. These results sharply contrast with Alaska Air's rising profits and stock performance today. You can see up over 1%, American down 9%. Scott?
Thank you for that, Christina Partsinevelos. Moderna shares jumping today. That company working towards developing a norovirus vaccine. Angelica Peebles here with those details. Hi, Angelica.
Hey, Scott. Moderna telling me that the 25,000-person trial is enrolling ahead of schedule and that there's clearly a lot of interest in this vaccine. Now, they can't say definitively if that's because of this year's spike, but it's no doubt that this has been a bad year for norovirus. Outbreaks are already up 36% this season compared to the last one. Now, whether we see the data later this year or next year depends on how quickly Moderna gets enough cases to go in and analyze how well their vaccine works. And the goal here isn't to keep you from getting norovirus, it's to make you feel a little less awful if you do get it. If you're lucky enough to not know from firsthand experience, norovirus is a really nasty stomach bug, and the goal is to keep people out of the hospital. That's especially important for seniors. They make up the majority of the 900 norovirus deaths that we see in the U.S. every year on average. Scott?
Angelica, thank you. Angelica Peebles still ahead. Texas Instruments reporting top of the hour. We'll tell you what to watch for when those numbers hit the tape. We're back on the bell just after this.
Ready AI.
Up next, we'll get you set for earnings and OT. What to watch for from Texas Instruments and CSX. We'll do that in the market zone. We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day, plus what to watch out of two key earnings reports in OT. Christina Partsinevelos on Texas Instruments, Frank Holland on CSX. Mike, I'll go to you. We are on track to get that closing high on the S&P, which we just missed out on yesterday.
Yeah, I mean, pretty low volume, very mixed breath, but just enough lift internally in the market, especially in a handful of the big names, to get us this record. It feels like the market's in a relatively comfortable place given what we know, what we can actually observe in front of us. We're not pricing in speculative policy moves. I think it's basically built upon what we know and what we can plausibly expect from earnings. And I think every day that we do get some kind of hints or pronouncements, and it's not across the board stiff tariffs, it's fine with the market. Honestly, I don't think we're reacting to anything else. The 2-year note yield took a tiny blip lower when the president said he wants rates lower at 11 a.m. Eastern time this morning, but it's not as if we've really repriced everything for that purpose. So I feel like, we got 57 new all-time highs last year. We're sort of just continuing along that track.
Oil's down today, perhaps on those presidential comments as well, addressing Davos. Christina Partsenevelos, we have earnings to deal with. Texas Instruments, what to watch out for?
Yeah, I'm saying it's like a reliable workhorse in your investment stable. Its chips are everywhere, from the old calculator in your desk drawer to the smart fridge keeping your groceries cool. And that's why it's seen as a bellwether for non-AI cyclical plays. Wells Fargo noting some industry headwinds in the industrial sector, but also spotting a silver lining in China's auto market, thanks in part to some fresh government stimulus. Texas Instruments is over 70% exposed to auto and industrial markets. The big question, though, with earnings, gross margins. The street wants 57%, dip below that, and investors might get a little bit jittery. Jefferies actually ran a buy-side poll asking when analog semis should start to outperform the stocks. Net, investors expectations are for the second half of 2025, meaning that bottom may not be here just yet.
All right, we'll see you with those numbers. Thank you, Christina. Frank Holland, tell me about CSX.
Hey there, Scott. CSX shares, they're flat since the last quarter, underperforming the market and the Dow Transports. Revenue is forecast to decline 3% year over year, profit to fall by 6%. The merchandise segment is where CSX gets about 60% of revenue. That's where they move chemicals, petroleum products, food products, auto parts, etc. It's expected to see a very slight year-over-year increase. The pull ahead of goods ahead of a potential port strike on the East and Gulf Coast ports where CSX operates, likely a tailwind for that segment. However, analysts are expecting that the rail will face price pressures, with Bernstein forecasting a 5% decline in revenue per unit. CSX is coming off 5 consecutive quarters of revenue per unit declines. Analysts will also be looking for any commentary on the coal franchise that generates about 15% of revenue for CSX. The EIA data shows that U.S. coal consumption, it spiked 32% sequentially in Q3. That's the most recent month of data. Also, coal consumption is forecast to increase very slightly in the U.S. in 2025. Back over to you.
All right, Frank, thank you. Frank Holland, we'll see those numbers in just a little bit as well. Mike, I'll turn back to you. 60.90.27 is the old closing high to watch. We're going to take that out, barring something unforeseen here at the finish.
Sure.
And by the way, NASDAQ's now gone positive. One of the reasons why the S&P's been so strong is because of mega cap tech of late. NVIDIA's green, Microsoft green, Meta, Amazon green as well. And Netflix, of course, is still up another 3%.
Meta in particular today is giving you the big push to the upside. Actually pretty balanced. If you look year to date, the S&P 500 is up almost 4%. Okay, it's the third week of trading this year. The Russell up almost that much, equal weight S&P up almost that much. So we keep trading off as to whether this is a broad or a narrow rally. It's been fine for now, I think, to have that rotational action in there. I think it's also worth noting that when December 6th, I think it was, when we had the previous all-time closing high in the S&P 500, bond yields were a lot lower, right? So we kind of up about probably 0.5% in the 10-year Treasury yield, and you've been able to absorb it for the right reasons. You keep dialing forward to a new 12-year block of forward earnings, and the market can make its peace with the idea that the economy was able to withstand rates at this level, at least so far.
All right, so thank you. I'll see you tomorrow. We'll get that new closing high on the S&P, as I mentioned. And a big shout out as well today. Wall Street Bound, 5th anniversary, Troy Prince, the great work that they are doing. They are ringing the closing bell here at the New York Stock Exchange, looking for the next generation of Wall Streeters, and we salute them for that. Does it for us into OT.
That's the end of regulation. Wall Street Bound ringing the closing bell at the New York Stock Exchange, and Aliana doing the honors at the NASDAQ. We're going out at session highs here with the S&P 500's first record close of 2025, closing above 6,100. It's also the first record close for the SPX since December 6th. Healthcare and industrials taking the lead today. Every sector in the green. That's the scorecard on Wall Street, but the action is just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan with John Ford.
And we'll be all over the markets, pushed to record highs throughout this show. Plus, we're moments away from earnings results from Texas Instruments. CSX will bring you those numbers as soon as they cross.
Let's get straight to the market action with BD8 Capital Partners CEO Barbara Duran and Crossmark Global Investments CEO and CIO Bob Dahl. Great to have you both here. Barb, I'm going to start this conversation with you. It looks like as we settle out here, maybe 61.18 for the S&P 500. We've seen a nice rally. After a pullback to start the year, we've really reversed course here for the major averages and for stocks. Can it continue from here, especially given the fact that you have a key ingredient that's still missing, which is inflows from big money managers?
Right. And I think, it could be a while in terms of even that 7 trillion sitting in money markets. Still, that comes out because interest rates are still high enough to attract it. I think this can continue. Anytime we've had a big rally, though, you always have to be concerned about a momentary pullback, when things get, and I don't think they're ahead of themselves yet because earnings are just starting. And I think that's going to be key. Valuation is clearly a concern, but I would say the market is somewhat fully valued. But with earnings coming in, as they come up and guidance goes up for the year, I think that these companies will grow into that. So I think there's more to come this year. I think it's going to be a solid year. Inflation seems to be coming down. You had the CPI and PPI numbers last week. And, this week looks like there's people are excited about the pro-growth policies of the new president, President Trump.
Okay. We've got Texas Instruments out. We're going through those results. We're going to bring them to you in just a moment. In the meantime, Bob, I want to get your thoughts on this market here at this valuation, especially as you do say you see more headwinds than tailwinds.
I do. Hard to quarrel with the earnings. They've been quite good since this fourth quarter earnings season started. Suspect they will continue to be. My complaint is valuations. A lot of the good news is in the market. Unless you're going to tell me inflation really is going to 2% without a recession, I struggle with that. I think inflation's a bit sticky, stuck 2.5 to 3, and multiples reflect closer to a 2% inflation belief.
Okay, I want to mention CSX results are out as well. We are going through theirs. Initially, both Texas Instruments and CSX are lower. Barb, I wonder, can this market, you talked about your expectation that it can continue higher, but without the mega caps also being considerably higher. Over the last couple of years, it's sort of like different mega caps have handed off the baton leading this. At this point, is it going to take more smaller stocks, more broadening for the market to head higher?
Well, I think what we saw last year was this continual rotation, because I think people want to put money to work. They know this is a bull market. They know the economy is strong, and all the data coming in supports it, that one should be in the U.S. stock market. But when valuations are this high, it is a problem. But you saw it even this last week. Yesterday it was pretty much the mega cap tack, the AI play, and yet the industrials, have also been having a strong start to the year. So I think we're going to see this back and forth rotation. Now, small cap, if that's what you're meaning by small, I still don't see small cap performing here. I think that's a lot of those names. It's either some 40% of their debt is short term or tied to variable rates. And I think with rates high, they're not going to do that well. So I don't see that as potential play. And I think that'll continue to be a trade where people will jump in because it's lagged, or they'll say, oh, for 10 years it's been behind the S&P 500, but it's been for a good reason.
Yeah, I didn't even mean small so much as maybe smaller than a $1 trillion market cap. But Christina Partsinevelos is ready with those Texas Instruments results. Let's get them. Christina.
Yeah, we have a beat on the top and bottom line. So EPS coming in at $1.30. That's 10 cents higher than what the street anticipated on revenues of $4.01 billion. It's the guidance for Q1 that is slightly weaker than anticipated. EPS coming in the range is less, 94 cents to $1.16. Revenue, we'll call it relatively in line, but nonetheless, it is still weaker. And they're saying, too, I'm just reading the report, revenue decreased 3%. We talked about that. And this is the first quarter outlook. Yeah, what we're seeing is just a weakness in the Q1. So I'll go through to see if we can get full year soon. But you can see the stock reacting negatively to that earnings outlook.
Christina, thank you. Barb, Texas Instruments results not expected to be great, in part because of the lagging recovery in autos and industrial. So does it fulfill its bellwether role for you here?
Well, not really. I think Texas Instruments has a special set of circumstances. I mean, they're really tied, to analog. They're not in the AI play. And so I think that you're looking at the rest of the economy, and the GDP number right now for the fourth quarter from the Atlanta Fed is 3%. So I don't think this is giving us a read in the economy. They've got, there's more competition in certain aspects there. Things in their auto and industrial probably haven't bottomed, but that's, I think, because of the analog chips that they do. And there's a lot of capacity there.
Okay. Bob, I want to get your thoughts on what we are seeing in some of these more economically sensitive parts of the economy, whether it is industrials. We're awaiting these results from CSX. We've seen some pretty big moves in transports, for example, materials just in the last couple of days, and what it signals about this rotation or increasing breadth in the market.
I think we do need the improving breadth. I think we'll get it. I agree with Barb. It's not small cap. It's just broader within the 500 or the Russell 1000 even. And we will get this back and forth. Yesterday, tech was the cat's meow and everything else was ho-hum. Today, it's sort of the opposite. I think we're going to get a lot of that. You put the politics on top of that. We'll get a tweet one day that makes us feel good, a tweet the next day, not so good. So I think volatility will be higher, and that doesn't mean down. That means in both directions. I think we're going to bounce around a bit more.
Okay. Let's see, Barb, when we're looking at CSX, and we've had a number of different transports reporting up to this point, I know it's not AI necessarily, it's not some of the hot stuff in the economy, but what I was referring to with Texas Instruments is more the bellwether for some of that autos and industrial stuff. When we're looking at beyond the things that are hot, how important are these earnings to you adding all that together?
Well, I think that you're talking to me, not Bob, or was that question for me or for Bob?
Barb, sorry. Yeah, there was an R in there. It's hard to hear.
Thank you. Yeah, well, I think ultimately they are telling us something, but it's really about looking forward. And so much of the industrials have run up in this, even this year to date. I think it's 7 to 8%. Because the anticipation of the pro-growth policies, of the Trump administration that will spur these on. I think we've been in a freight recession for some 3 years, and people are trying to figure out what to do. This hasn't held the economy back. There's pockets, as we know, in housing and in freight transportation and even Texas Instruments, where other semis have done very well. In fact, they're lagging the SOX index. Yeah, they tell us something, but it's not, in the grand scheme of things, has not been a real tell in these two particular names for how the overall economy is doing.
All right. Barbara Duran and Bob Dahl, thanks for kicking off the hour with us with a record close for the S&P 500. Well, we told you CSX earnings are out. Let's get to Frank Holland for the numbers for the railroad.
Hey there, Morgan. Looking at shares of CSX, they're moving lower, more than 2% lower after a miss on the top line and earnings of 42 cents a share that we are not comparing to estimates. Merchandise, its biggest segment when it comes to revenue, generates about 60% of revenue. That beat estimates with revenue growth of 3%. They say they saw positive volumes and favorable pricing. However, the company did say the impact of hurricanes and also the Key Bridge outage. Remember that bridge in the Baltimore area being knocked out by a ship earlier in the year. That impacted the quarter overall for the company and the full year results. So again, shares of CSX, they are lower right now after missing on the top line, earnings of 42 cents a share, not comparable to estimates. Back over to you.
All right, Frank Holland, thank you. It looks like we've got volume growth low to mid-single digits for 2025 guidance as well. Don't miss my exclusive interview with CSX CEO Joe Henricks. That will be tomorrow at 10 a.m. Eastern on Squawk on the Street. Shares are lower, John.
All right. Well, the S&P 500 is at all-time highs, but not every sector has enjoyed the rally back to records. Let's get to Mike Sancholi for a deeper dive on one of the unloved sectors of the past month. Mike?
Yeah, John. In fact, unloved for a long stretch of time, a couple of years, consumer staples. And it has relevance on a few different dimensions. One, it shows you that the market, here you have the equal weighted consumer discretionary against consumer staples, really opening up a wide lead on a 2-year basis. It shows that the equity market is pretty confident in the economic growth story. If you would see some kind of a bid in defensive type stocks like staples, if in fact you were talking about recession risk going up or anything like that. I think we might be at risk of overreading this, though, because of the secular issues and the news flow that's working against staples, such as GLP-1s in food, such as inflation coming back and them losing some pricing power. But nonetheless, this so far is the message. And one of the results is Netflix and Procter & Gamble, both with some numbers this week and both pretty good. They've kind of swapped places in terms of the largest, what you might call household necessity. Over $400 billion market cap now for Netflix. It's for the first time eclipsing Procter & Gamble. So just a little bit of a sign of what the market prefers here. P&G's got about double the revenue, about 60% higher net income for the 2025. So it shows you paying up a lot more for $1 of Netflix earnings and revenue than you would Procter & Gamble. Now, one of the results is some pretty high dividend yields among some of the worst within staples. That would be the food companies. Again, a lot of things that are really pushing against these as fundamental stories. But on this, 15-year or 10-year chart of the dividend yields, you see we're pretty much up near where they've peaked recently in the 4% range for Smucker, Campbell, Hormel, Hershey. The problem here is safe short-term bonds are now yielding at least that and more. And so there's not a lot of impetus for yield hunters to go in this direction. Yes, dividends can go up over time, but unlike back here in 2018 or so, when short-term bonds were yielding very little, there's more competition for these low-growth stocks right now, John.
Mike, tell me, Netflix being in a group with Staples, I don't know. I mean, I know some of these shows are can't miss, but are they really can't miss? When I think of Staples, I think of things that you can't do without.
No, of course, absolutely.
It's behavior. So when investors think about that group and Netflix alongside it, how should they parse the difference between what makes Netflix more of a staple versus discretionary?
Well, the way I would think about it is the reason that Netflix is at a $400 billion market cap right now and trades at 35, 40 times forward earnings is because investors collectively are saying that consumers are treating it as a must-have. And it's one of the last things they would do without. Even within the entertainment and sort of services budget of a household, it's sort of you'll hang on to that and you'll probably cut back elsewhere if you have to. It's the old core and explore. Netflix is your core. If you have some extra cash, you'll get extra things alongside it. But no, the business dynamics are obviously different than, putting stuff on shelves and trying to get an extra nickel per box of, dryer sheets or something like that.
All right. Though they are raising prices. Mike Santoli, thank you. Well, after the break, we'll take a closer look at the results from Texas Instruments and the read-through for chip stocks and the rest of tech.
And President Trump just signing a wave of new executive orders at the White House relating to crypto, science, and technology, and more. We've got new details from Washington when Overtime returns.